What's up? This is Wade with Trade ATS, and I want to welcome you to the 7 Insider Secrets of Trading Mastery. So, what this is a presentation that I've put together that compiles a list of the things that I think that if someone is serious about learning to trade, these 7 things are things that I feel cannot be ignored. I'm going to be giving these out as 7 individual lessons, so make sure that you like and subscribe to our channel so you can get notified when each new lesson comes out. Your trading outcomes are controlled by 2 natural emotional states and 1 outside variable. Together, these give you an exact formula for why people take losses. I'm not talking about fear and greed as the 2 natural emotional states. Most people will tell you that traders are driven by fear and greed. That's why they get in and get out and make the decisions that they do. That does come into play. There's definitely some fear and greed at play. But there's 2 emotional states that are even more powerful, that are much more responsible for why you do what you do in trading, and these are pain and pleasure. When I first discovered the frameworks that I'm about to share with you right now, I was absolutely blown away. To me, there's really no better explanation why the markets work the way they work and why people get the results that they get. To me, this is everything, one of the most important things that I could teach you, and this alone is literally what led to the discovery of the master pattern frameworks, how we put that together, and our software, Action Threshold software from Trade ATS. This one concept led to the creation of all that and the way that we view the market. So I'm excited to share this with you. So let's break down these 2 natural forces, or these 2 natural emotional states. Again, we have pain, we have pleasure. Let's start with pain. What does this mean? Well, in life, in the physical world, what does pain typically mean? What does it make us do? Well, pain typically is always going to result in us taking decisive action to make it stop. You could think about, like we see in the picture here, touching a hot stove. You're going to feel that heat on your hand, even if you accidentally brush up against it. You're going to feel that heat. It's going to trigger a pain response through your skin receptors that go straight into your brain. And without even hardly thinking about it, you're going to get a natural gut reaction to withdraw your hand. You're going to say, ouch, and you're going to pull your hand back. You don't even really need to think about it. It's going to be a self-preservation gut reaction that is going to naturally happen. Now let's consider pleasure for a moment. What happens when we feel pleasure or are in a pleasure state? Well, it's typically going to result in no decisive action taken. And why is that? As humans, we want to pursue pleasure, things that make us feel good, and we want them to last as long as possible. We don't want to take any action to make them stop. It's like getting a massage like we see in the picture here. This lady is not thinking, what do I need to do to get out of here? She's probably thinking, I never want this to end. This is great. What's notable about these 2 natural forces, or these 2 natural states, is that no one had to teach you about these things. These are things that are instinctual and natural. When you feel pain, you're going to do whatever it takes to make it stop. And when you feel pleasure, you're going to want to make it last as long as possible, and you'll go to great lengths to figure out how to get pleasure. So how do these natural forces, pain and pleasure, that typically serve us well in other aspects of our life, how do they really mess us up as traders and sabotage our results? Well, it comes down to the variable that is trading. We're navigating market price action that is typically going to be ranging up and down 95% of the time, and that's on every time frame. How does this combination create the formula for losses? Well, when feeling the pain of financial loss, your natural instinct will be to make it stop. Losses are painful, whether it be a trade that you just initiated, that you misjudged the entry, and now you're out of the money. It's not a comfortable feeling. And if you feel uncomfortable with that, you're normal. You should feel uncomfortable because you potentially could be losing money. This could also be if you were in a trade that was in the money, you were way up, and now you overstayed your welcome and it's starting to come back against you. What was once a great win is now turning into less and less of a win, even to the point where you're at break even, or maybe now at a loss, which is really painful to know that you could have taken that profit off the table. A lot of people experience this with Bitcoin recently. Your natural instinct is going to want to be to make that pain stop. And the way you make pain stop in trading is you click the button and you stop the losses. You get out of the trade. That is decisive action. Now, when it comes to pleasure in trading, you do the opposite. You're not taking decisive action. You're not booking the gains. When feeling the pleasure of financial gain, your natural instinct will be to keep it going. You, again, never want it to end, just like the massage. In fact, you're thinking about how good it could really be. You're thinking of Lamborghinis and private jets and trips around the world, when in reality, you should be taking those profits off the table and selling into that strength. Because why? Because markets range 95% of the time, and you're likely to be out of the money on that trade if you overstay your welcome. So just to bring this home for you, when trading, when you feel pain, you're going to naturally want to take decisive action at what would be the wrong time. This is when you're at a loss, you're going to want to click the button and get out of the trade, make the pain stop. When you're winning, when you feel good, when you feel pleasure, you're going to want to overstay your welcome. You're going to think that it's going to keep going higher and higher and higher. This could equal no action at what should be the right time to take action and book the profit. So you guys can see how these things really can work against you. You're doing the wrong thing at the wrong time. When you combine this with ranging markets, this guarantees that at some point in the trade, whether it be immediately or later on, if you overstay your welcome, you're going to feel pain at some point in that trade. And during the pain part of that trade, that is when you're likely to take the decisive action. And when you take the decisive action to close a trade, you seal in your results. This is why it's so easy to be a loser in trading. No one has to train you. You don't even need to think about it. You are naturally a loser because of these natural forces we are all subject to. So how do you master pain and pleasure? Well, you need to understand that there's no way around this human tendency to react to pain and pleasure the way that we do. Just accept it and become self-aware. I can't emphasize this next one enough. The amount of pain that you're going to inevitably feel as you go about the process of trading is in direct relation to the risk that you're taking on. The way that you mitigate against having too much pain is by using lower position sizing. This way your pain will be less intense when you misjudge an entry like everybody does. This will in effect extend your time in market. By trading lower position sizes and extending your time in the market by using wider stop losses, this is going to allow a much higher percentage of your trades to actually come around and put you in the money, giving you the ability to take decisive action and book the profits like you should. Understand that all the other traders are affected the same way, but most don't know it. Make that your advantage. Use their pain and pleasure points to your advantage through your own market analysis and trade timing. This is what we do through the master pattern analysis. This pattern, this way of looking at the market, is built around this concept. By understanding where traders' pain points are, that ultimate pain threshold where they're going to put out of the money, that's where you're going to understand where to enter and exit the market. That's how you're going to be able to predict where markets are likely to go. In a situation like this, we can see that the market has broken out. We had a neutral point right here, a balance of supply and demand, and then it broke out. A lot of the breakout traders are going to want to buy into a situation like this because it just looks so easy. Remember, markets range 95% of the time. Where would anybody that bought in this run up likely put their stop loss? They're going to put it down below this low and back down here. That's why we have what we call liquidity lines here. You don't need our software to do this, but you can look at the predominant highs and lows and understand where likely people's stop losses are going to be. As this market went up, you can say we went through another balancing point. It went up, suckered in a few more people, and then we had a huge snap down to pick up those stop losses. Why does the market go to where stop loss levels are? Because the market doesn't care about price, it cares about liquidity, and there's liquidity in those stop losses, predictable liquidity that the market makers, the institutions can count on. If they drive price there, they know that there's going to be, in this case, willing sellers from people that have bought. The other side of a sell is a buy. They can accumulate at a discount and take the market in the predictable price direction. You could also see as this market fell short right here, based off of this equilibrium point, we got new liquidity lines started up at that high, because this is getting new traders to go short and chase the market. Traders are always chasing the market to their detriment. So as it came down, they picked up liquidity down here. They got new traders to go in short. Anybody that shorted the market coming down here, their stop loss is going to go above that high. And that's why we have liquidity lines created up there. So it literally goes from liquidity to accumulate, liquidity to distribute. Pick up your positions here, your inventory, liquidate it here, all based off of predicting where traders are going to put their stop losses. This is something that you really need to pay attention to. understand where the equilibrium points are, where the points of contraction are, draw out where the likely stop loss levels are going to be relative to those breakout points, and then map the market for those sensitive price areas and see how it reacts. That'll really help you predict what's likely to happen. So that pretty much does it. If you like this lesson, remember to like and subscribe to our channel. That way you get notified when we release the next insider secret of trading mastery. We'll see you on the next one.